Welcome to Global Tax Talks Tax in 60 Seconds. I'm Will Morris, and here are some things to watch out for in the coming week. First, there has been some talk in the past week about whether or not the US will terminate the US-China tax treaty. The question was originally raised in the presidential executive order on the America First investment policy back on February 21, but since then has laid dormant until the past week, when a number of Washington, D.C. trade associations, having presumably heard something, wrote to the administration to ask them not to cancel the treaty. As of filming, no decision appears to have been made, and the fact that the US Treasury Secretary and the trade representative are heading to Switzerland to talk to a very senior Chinese economic official indicates perhaps that action may not be imminent. However, terminating the treaty would have some significant knock-on effects for US businesses in China, as well, of course, for Chinese businesses in the US. I'll definitely come back to this when there is more news, but again, it's worth noting, as I've said several times before, this is not really about tax. This is much more about trade. Tax is not in the driving seat. Anyway, moving around the globe, as many of you will have seen, the recent Australian election produced a strong win for the centre-left Labour Party. The consensus seems to be that this means the changes to the country's public country-by-country reporting regime are now unlikely, with first reports generally due from non-Australian MNCs by December 31, 2026. Further action is also expected relating to the issues of embedded royalties and withholding taxes on those. So let's see what happens. And finally, in a long overdue return to the Global South, Nigeria is overhauling its tax system through the Presidential Committee on Fiscal Policy and Tax Reforms, with some important changes contained in the National Tax Bill expected to be enacted soon. These reforms aim, among other things, to broaden the tax base, improve compliance, and align Nigeria's tax regime with global best practices, thereby boosting government revenue and fostering economic growth. An encouraging message. Key changes include aligning the company's income tax, or CIT, and capital gains tax, or CGT, rates at 25%, CIT down from 30%, CGT up from 10%, and applying CGT to indirect share sales in Nigerian companies. A 15% minimum effective tax rate will apply to large domestic companies and Nigerian members of multinational groups, while CFCs, or controlled foreign company rules, will tax certain undistributed foreign profits. And, although this has been contentious, value-added tax will rise, albeit relatively slowly, to 15% by 2030, with broader input VAT recovery. And excise duties will cover telecommunications, gaming, gambling, and unofficial currency exchanges. Mandatory e-invoicing in a new tax ombudsperson office will enhance compliance and taxpayer protection. The national tax policy provides for a transition period to allow taxpayers and businesses to adjust to these reforms, ensuring a phased and orderly implementation of the new measures. It's good to see this moving forward. Anyway, thanks for joining me, and come back next week so that you stay global tax ready.